Bear markets are periods characterized by falling prices and cautious investor sentiment. Understanding bear markets is essential to managing your investments and planning for a secure retirement. You may have heard the term bear market and bull market lumped together. We've already covered bull markets in a previous episode, but what exactly is a bear market and how does it differ from the bull market?
A bear market, unfortunately, that's part of the whole plan, and that's what we try to guard against here at Capital Financial, is to protect ourselves against those bear markets, where basically a bear market is where the market is going down in value, where you're seeing a loss in your account. And that's where, as we talked about earlier, when you get in retirement, I just don't have the time to recover from those losses that go along with investing 100% of your assets in risk type investments, because if you're in that risk bucket, there's going to be bull markets and there's going to be bear markets, meaning there's going to be years where the market goes up, there's going to be years where the market goes down.
When planning for your retirement, it's important to know the key characteristics of a bear market. These periods are marked by declining market sentiment, economic slowdown, and increased volatility, factors that investors must recognize and understand.
Obviously, recognizing a bear market, which the market is down 20% or more from its high in the last couple months, it's a bear market kind of thing. So what we need to make sure is, if we are in a bear market, we don't want to keep doing the same thing over and over again, expecting different results. Now, could it be a good time to buy? It's always a good time to buy when the market's low. Warren Buffett always said, buy low, sell high. But when you buy low, could it go lower? So you have to ask yourself, how low could this go? And is this a good time to buy?
Well, a lot of times people will say, oh no, the market's going down, and let's say they're putting their money in their 401k, and they stop putting money into their 401k because it's going down. By all means, don't stop, because you got to keep buying those positions. So you can't stop what you're doing. Once you put something into practice, you got to keep going forward.
Like all investing, bear markets come with a certain level of risk. So let's discuss risk management. How does diversification help protect portfolios during bear market conditions? A diversified portfolio can mitigate risks by spreading investments across different asset classes, thereby cushioning against market downturns.
Yeah, the secret here is to not have all your eggs in one basket. Don't have all your money in one stock, in other words. Okay? So come up with a plan. You can either get a good mutual fund or ETF. Even that, I wouldn't put all my money in that. Like Vanguard has a good S&P 500 fund. I put my own money in there. VOO is the symbol, but I don't put all my money in there. Again, diversification is not having all your money in one place and not putting all your money in one place at one time. So spread it out amongst different places, but don't do it all at once. They say, Coach, I'm going to put together a portfolio with NASDAQ ETF, a S&P ETF, and a Dow ETF. And I'm going to take $100,000, I'm going to put it all in tomorrow. I would say, why don't you just take $20,000 and do it tomorrow, and then wait a month and put $20,000 again in these same ones. Therefore, you're diversifying and you're dollar cost averaging, and you're not putting all your eggs in one basket at one point in time, because nobody knows. It's about a 50-50 chance the market will go up and down from day to day, it seems. So you don't want to put all your money in. It's like flipping a coin. Maybe you flipped it wrong and you put all your money in there. So even if you put it in and the market keeps going lower, could it recover? Yes, but it's going to take a while, and now you're going to have to recover just to get back to where you started, and that's not where we want to be.
Depends on what's going on in the bear market, what stocks are being affected, but the best way to combat a bear market, to be honest with you, the best way is to go inside an insured account. If you have an insured account, you are not subject to the bear market. You either get a zero or you enjoy the bull market. That's it.
Understanding bear markets and the role of diversification can help you navigate challenging economic cycles with greater confidence. If you're looking for personalized guidance on safeguarding your investments during market downturns, our team is here to help. Coach Pete and the team at Capital Financial are ready to offer tips and strategies to get you where you want to be in retirement. Take advantage of the no-cost, no-obligation financial review to understand the ins and outs of your retirement plan. A customized plan based on your wants and needs. Contact us today. Also, be sure to like this video and subscribe to this channel for more retirement help.